Hello, I am David Bulow, Director of Educational Programs at Performative, the online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar entitled Learn How to Structure and Execute a Debt Compliance Program. In this webinar, you'll learn how to identify any weakness in your debt compliance process and know which effective practices you should adopt. Results of the Associated for Financial Professional Debt Compliance Survey that reached out to over 400 companies last fall will be presented. S&P's latest annual 30-year default study shows that the 5-year risk for hard defaults and rating downgrades ranges between 19% for A's and 24% for B's. These risks are symptoms of poor operating results that will likely lead to technical defaults long before hard defaults such as a missed payment. In this session, we will use the S&P data to show why this high, hard, and technical default risk justifies a strong compliance process, especially for non-investment grade companies. While finance is not responsible for poor operating results, finance is responsible for proactively managing senior management and lenders about these potential covenant issues. This requires a strong debt compliance process that comprehensively manages the current quarter and identifies potential issues so they can be monitored, managed, and mitigated with succeeding quarters. Few items before we get started. I want to thank everyone who is returning, and for those who are new, Performative is the largest and fastest growing online resource for senior level corporate finance, treasury, and accounting professionals. We're a uniquely valuable online peer network with direct subject matter expert advice. We've also recently launched our Performative Exchange, which is like Yelp but for corporate thin products. This all comes completely noise-free and without any advertisement. Check it out at performative.com. The links to today's presentation and a recording of this event will be sent out to all attendees within 24 hours of the event. The presentation is already posted at performative.com/resources for you to download and follow along. For those who would like to qualify for CPE, you need to answer all 3 polling questions and need to have pre-registered for CPE credit. If you do have any questions around CPE, please email us at cpe@performative.com. We like to make this interactive, and we'll ask everyone to use the question box in your GoToWebinar panel as we will get these to our speakers during the Q&A session. At the end of today's presentation, you will be asked to take a short survey, which we ask you to please take that last minute of time to fill out so we can continue to improve. Today's learning objectives in this event is to quantify the risk of a technical default, understand weakness in the company's current debt compliance process, and understand how to address specific weaknesses in a company's debt compliant process with alternative and more effective practices. And now I'd like to introduce our 2 speakers. First, I'd like to introduce Jim Simpson, co-founder and managing director of Debt Compliance Services. Jim has over 36 years experience as a senior financial officer of corporations, both large and small, in addition to having served as an outside consultant throughout his career. Prior to Debt Compliance Services, Jim was an executive vice president and chief financial officer for Moore Medical Corporation, a public mid-sized health products distribution company. Before his tenure at Moore Capital, he served as an executive vice president, chief financial officer, and director at mid-sized home textile company, C.S. Brooks, treasurer of a leading pharmaceutical and health company, as well as various senior finance positions at KPMG, PepsiCo, Champion International, and Deloitte & Touche. During the course of his career as a corporate financial officer, Jim has successfully conceptualized, negotiated, and closed IPOs, private equity, subordinated debt, mezzanine loans, private placements, leases, cash flow and asset-based loans, multi-currency facilities, and commercial paper program. Jim holds a BA in political and an MBA in finance. I also want to welcome Jeff Wallace. He's also a managing director and helped co-found Debt Compliance Services. Jeff helped co-found Debt Compliance Services in 2009. This is the only firm providing web-based automated debt compliance services. He also founded Greenwich Treasury Advisors in 1992. His corporate experience includes positions as Vice President, International Treasury at American Express, Assistant Treasurer at both Dun & Bradstreet and Seagram. He holds a CPA and started his career with Price Waterhouse. And with that, I'll turn it over to Jim.
Okay, David, thank you very much. Welcome everybody and thank you for all signing up. Okay, the agenda, what we're going to do, we'll have a quick executive summary, and then I'll be speaking about understanding default risk and take some time about that because we believe that default risk is probably one of the most misunderstood and underestimated risks that companies face. Then Jeff will take you through the AFP Debt Compliance Survey that we conducted last fall, and then he will talk to you about building a strong debt compliance process and achieving 5 debt compliance objectives. And finally, we'll offer you the ability to benchmark your own company's debt compliance. And we'll have an appendix available as well. Okay, with that, I'm just going to turn it back to David for just 1 second. We have our first polling question.
You should be seeing your polling question on your screen just shortly. We do ask everyone to answer all the polling questions, even if you're not looking for CPE, as these are statistical in nature, and this helps us get a better result. If you do have questions during the presentation, please use the question box in your GoToWebinar panel, and we'll try to be getting those. Something a little different, we are off doing this polling question early, and we will be showing the results of that in just a few seconds here. I'll leave it open for just a little bit longer so everyone can get their answers in. Just a couple more seconds, I will be closing it down. I'll now close this down, and we will share the results, and they should be showing up shortly here. And
okay, thank you, David. Well, as you can see, we have a very interesting crowd here today. We have investment-grade companies of BBB and above, which is in the like 70% range, almost 80% range. So this will lend itself to a very good discussion today. And with BBs and Bs and below, we only have about, what is that, about 22% or 23%. So what we'll do is we'll start on, if we could just move to the first slide, David. Okay, as I said at the very beginning, the most misunderstood, in our view, financial risk that a company faces is the debt default risk. And it's a risk that is seriously underestimated by speculative grade companies. But as you'll see in a couple of minutes, actually investment grade companies seem to slightly overestimate that risk, which is a real interesting fact. We'll talk a bit about the S&P's latest annual default study. And it shows how the 5-year risk for hard defaults and rating downgrades ranges from anywhere from 19% for A's to 24% for B's. And these symptoms of poor operating results can lead to technical defaults long before hard defaults happen, such as a missed payment. And I think, as David said at the very beginning, while finance is not responsible for poor operating results, finance is responsible for managing senior management and lenders about these high probability covenant issues. And the reason for that is to maintain the company's access to funding at the lowest possible cost. But finance can only do this if it has a strong debt compliance process. And that means it has to comprehensively manage the current quarter and gather the information about all existing and potential covenant issues so they can be monitored, managed, and mitigated in future quarters. And using the results of the 2012 survey that we did with the AFP, you'll see how to build a rigorous debt compliance process. And in this survey, we're going to introduce you to our grading system where we evaluate the effectiveness of debt compliance processes of the 401 respondents on 10 criteria. And we put those into two buckets. One is a structuring criteria. How do you set up your process? In other words, how do you set up your objectives? How do you assign responsibility? How deep in your organization do you go? How is accountability done within your company? And who has overall oversight? And then there's the execution criteria. And how do you use various tools like calendars, checklists, non-financial covenant reviews, prospective non-financial covenant reviews, and prospective covenant ratio and permitted basket practices. So we're going to get to all of that in this presentation. But let's start talking about default risk. And just to get down to the very basics, and I'm sure most of you are aware of this, but there are two types of default, broadly speaking. There are hard defaults and technical defaults. And the hard defaults are those that you would obviously know. They're missed payments, distressed debt exchanges, bankruptcy filings. And this is the S&P's definition of a default. Technical defaults is any other type of missed debt obligations, such as broken ratios, permitted baskets, and non-financial covenant failures. And one of the things that a lot of companies are surprised about is that non-financial covenants far outnumber the other covenants in a typical debt agreement. And so therefore, they're very important, but also neglected to a large degree. And when found, defaults must be reported quickly to lenders per the terms of the agreement. Otherwise, financial fraud could happen. So you need to include other lenders also in any other debt because of cascading cross defaults. Now, lenders want to immediately know the specifics of defaults, the default date, what steps the company has taken and or proposes to take to remedy the default. And the longer the period of default, the more the 2% penalty interest, for example, grows and is due. And then there may be justification for higher waiver fees. So if we continue along this, auditors also get into the picture because they want to know about the default date because issued financial statements may need to be restated. And as a matter of fact, under the ASC 470-10-45-11 requires that defaulted debt be classified as short-term for any covenant violation. And by the way, there is no distinction between a big default, a small default, a hard default, a technical default. It is any default. And then there also may be material SOX deficiency citations. Public disclosure can also then crater the stock price. As a matter of fact, there was a study done by a professor at Stanford University and a Canadian university about the impact on stock prices and valuation after a default. And it was somewhere on the order of about 25% in the first month after an announced default. Business disruption can occur as vendors, customers, employees take steps to protect themselves. And it's likely that it will cost finance, credibility, or worse. And as one of our clients said to us, it was the worst month of my life. Every day I thought I'd be fired. And I can attest to this. I worked with a client a number of years ago where they had a technical default on one of their subordinated debt agreements, which they were spending very little time on. And because of that, it cratered the stock price. It caused a whole bunch of turmoil. They had to pay a lot of money, and for a period of 6 to 7 weeks, they had no access to any of the credit markets. So they were living hand to mouth. Remedying defaults. Now, a lot of companies believe that most defaults that may happen, their lenders will come in and give them a pat on the head and say, okay, that's okay. And they may forgive some minor technical defaults. But for more serious technical defaults, things can quickly spiral out of control. In fact, as soon as a default is reported, a company is not in control. So even if a lender were to forgive you, or you believe that they would forgive you on that, they don't have to. And how they will deal with you is really a complex calculation of the penalty interest that may be accrued or to be paid, the evaluation of companies' management. And this is important because if there are continual little nagging defaults, the credibility of management gets impacted negatively very quickly. The company's current credit standing, the economic conditions in the company's industry, the current credit market. A number of years ago, back when during the crisis of 08 and 09, banks were not willing to talk that often, and they were, matter of fact, looking to get out of deals that had previously favorable pricing. And there are differing lender objectives in the syndicate, if you do have a syndicate, because there are different players today. They're not necessarily just bankers. They can be hedge funds. They could be any number of different financing operations. Now, let's talk a bit about how default risk increases significantly. And this is something that we're basing this analysis on S&P's 5-year rating transition rates. And this is a study that they do every year. And we are using as our source their 2012 the Global Corporate Default Study and Rating Transitions. And in this, S&P says that in 5 years, slightly more than 40% of the double Bs continued to be rated double B or better, while 60% have had credit downgrades, defaults, or become non-rated. And we'll get into some more detail on that, but as you can tell, that over time, that the possibility of a rating downgrade and everything that means can have a major impact on how your risk of a default may be growing. Now, let's talk a bit about underestimated default risk. And Jeff will get into a little bit about, a lot more about the AFP Debt Compliance Survey, but this little bit is very interesting. Now, investment-grade companies, and I would ask those investment-grade companies on the line to think to themselves what they believe their risk of a hard default might be. But in our survey, we found, and you can see that the A's and the triple B's there had a higher estimate of the potential for a default than was shown in the survey itself. Whereas the double B's and B's have been significantly underestimating their potential for a default. And we believe that this is based upon an adverse selection, because many of the speculative grade treasurers, if they really believed that they had a significant default risk, perhaps they might not be working at the company, or they may actually be doing a more thorough job on the covenant process. But regardless of the reasons, by underestimating their long-term risk, these companies are likely to implement inadequate debt compliance practices. And we'll see that in the survey data that Jeff will show you. And most importantly, at least from our point of view, and in years 3 to 5, this is when companies need to be most vigilant and proactive. They may have new and inexperienced compliance staff following an inadequate process. So what happens, it begins to spiral out of control, as I mentioned earlier. Now, let's go into how do you estimate technical default risk. First of all, S&P did not attempt to do that. And the reason that they didn't have the data to do that. But what we have done is we've looked at that. And if you wanted to look at a technical default, you could put it in between two bounds, a lower bound and an upper bound. And for the lower bound, we believe, and so does 93% of the people who took the survey, that the risk of a technical default must be at least equal to the hard default rate. I mean, it seems logical. So that we would put as the bottom rung of or lower bound of that. The upper bound is a function of the frequency of technical defaults associated with the stress of credit downgrades, defaults, becoming non-rated, which we explain in the next two slides. So summarizing our estimates, we believe that the 5-year technical default risk lies somewhere between the lower and upper bounds that you see here. So for a BoD company, it would be anywhere between 9 and 19%. And for a BBB would be between 2 and 10%. Now, let's talk a bit about the transition. And I mentioned this just a few minutes ago. The risk of a default is not static for a company from the very beginning. And as a matter of fact, the S&P showed how ratings changed for companies over time. So if you look here at this chart, you look at year 0. Okay, everybody remains at BB, but as time passes, some companies, as you see up here, become higher rated. There's still a significant portion that stay at the BB, but now you're starting to see companies that are getting downgraded, companies that have become non-rated or defaulted, and this grows over time to where at the end of year 5, you have about 40% of those companies that were BB still remain BB or higher, whereas 60% now are below BB or not rated at all. And this is a significant thing when you look at how the risk of a default grows over time. Now, to estimate the default risk or technical default risk, what we've done is we've taken the BB rated transition rates, and these are as per the S&P study. Then what we did is we did for anything below the BB rate, we assigned a weighting, which was our assessment of the probability of or the weighting of that transition rate or probability of default happening, and then added those together. So what you'll see is that the biggest part of this was in the non-rated. So you have a number of companies that in the 5-year time frame are now non-rated, and there can be a lot of reasons for that. You know, there could be good reasons in that they've been acquired by another company that's much bigger, or there could be that business has deteriorated significantly. So when you look at this, this is how we build up to this 18.9% technical default risk. And so now you have your lower and upper bound of a technical default risk. We'll skip that. We're going to go right to here. So let's talk a bit about this, this disconnect. And we've shown you how the risk of default is much higher than most companies believe or want to believe. And this is probably shown very dramatically here. And what we've done is we've assembled a number of other major risks that companies face and attached an event to them, given them our estimate of the probability of that happening and what companies are doing to mitigate this. So if we start off with something like property damage, and it could be a plant fire, the probability is less than 1%, or even if it's 2 or 3%, it's still very low. And companies spend millions of dollars on insurance, preventive actions, questionnaires, you name it. Liability torts, so your typical shareholder lawsuits, again, very low probability, but the amount of money that is spent and the time devoted to that is significant. And so on down this list. But now you come down to funding availability and specifically covenant violations. And as we've seen earlier, in the 9 to 19% probability for a default for a double B, the amount of investment in people, training, and dollars is minimal. And companies are taking this risk that can result in millions and millions of dollars of costs and business disruptions and so on. It can be as catastrophic, if not more catastrophic, than any of the other risks that we see here. So since many of the treasurers also manage the other risks, the disconnect in managing default risk is particularly acute once the company's true default risk is realized. What I'm going to do now is I'm going to switch it back to the second polling question, and David will take it from here. Okay, David?
Yes, thank you for that, Jim. You should be seeing your second polling question of 3 here on your screen just shortly. Here it comes. We do ask everyone, if you have questions for our speakers, please use the question box in your GoToWebinar panel, and we will try to get to those in the Q&A session. I'll leave this open for a little bit longer. If you are looking for CPE, remember you do need to answer all 3 polling questions, and this is the second of the 3. There'll be another one at the very end of the presentation here. So I'll leave this open just a little bit longer so everyone can get their answers in, and then we will be turning it over to Jeff as he gives us the second portion of the presentation. I will be closing this down, and we will share the results and let Jeff give us a few comments on that. They should be appearing here shortly.
Okay, so we do see the results, and we see a high level of what we believe are really the 3 serious weaknesses of any debt compliance process. 42% don't have a covenant checklist. Almost an equal number, and of course they are correlated. If you don't have a list, then it's difficult to document compliance with specific covenants. And of course, the question is that if every quarter you say you're in compliance with your covenants and you don't have a list of them, then how do you really know? And then about 1/5 of the group, no one is assigned responsibility for the quarterly compliance. And, you know, it's just simply not good management. We've picked these 3 weaknesses, and in the benchmarking data that will follow, we're going to show you how these weaknesses of companies doing them in the survey data are really not doing a good job elsewhere. Okay, so as Jim mentioned, we did a survey with the AFP last fall on debt compliance, and we've analyzed the survey on 10 criteria, and we asked how people structured their debt compliance. What were their objectives? Did they have a written policy? Did they assign responsibility? How deep within the organization did they go? Do they enforce accountability during their review? And is there board oversight? And then we looked at how they executed the policy and their use of a calendar, a covenant checklist, reviewing the non-financial covenants, and at the same time taking a look at the future with reviewing prospectively their non-financial covenants and prospectively looking at their ratios and baskets. For each criteria, we have assigned specific practices from the survey, weighting each practice by our judgment of the effectiveness. So as we go through each of the 10 criteria, you'll see what people are doing in various different subgroups, and also you'll see what our recommendations are by the practices with the higher weightings. When we've summed the practice weights by criteria and converted them to grades, and overall, out of these 401 companies, 8% were rated A, 18% B, average was 27%, 33 just barely passed, and 14% did not. And as you look through this, I think you'll agree with our ratings when we take a look at how effective they are. One of the major conclusions was that there was little risk-based debt compliance. In other words, you would think that companies with a large amounts of debt that were poorly rated would have pretty strong debt compliance processes. And alternatively, companies with small amounts that were highly rated probably wouldn't have some strong debt compliance practices. And as you can see in the chart, everyone, despite the crosstabs, say for the 500 million to $1 billion, that were less than double B, they were C. If they were double B, they were C. If they were triple B, they were D+, and greater than triple B, they were C+. Stated differently, the conclusion that we draw from the analysis was that the thoroughness of the debt compliance process is not based upon risk. And of course, debt compliance is all about managing risk. And we do see that the over $10 billion companies are doing the best job, but the companies that have over $10 billion in debt probably by necessity have 1 or 2 FTEs dedicated full-time to debt compliance, and so they've got the time to do it. And that's really the issue. We're going to see that there's been a significant lack of resources invested in the debt compliance process. It's due, we believe, to the lower perceived risk that we hope with the S&P study that Jim has done for you, showing you that that lower perceived risk is really a serious misunderestimate. Next slide. So let's talk about building a strong debt compliance process. For each criteria, we're going to present the results of 5 different subgroups to show the range of practices and their effectiveness. We'll show the entire benchmark group, and then we're going to show the 3 weaknesses that we've just told you about. Companies that have no one assigned to be responsible for debt compliance, companies that don't document their compliance evaluations, companies that don't use any covenant checklist. And in contrast, we're also going to show the companies that document their subject matter experts, and we'll explain that in a minute, who document the compliance evaluations, who are using questionnaires, and do reviews on a prospective basis of their non-financial covenants. We found that these companies, which were about 8% in total, who follow these things, have the highest overall rating of any combination of 3 practices. So let's go directly into the criteria, which is, let's summarize these 3 companies, or these 5 subgroups. And we see that the companies with these serious weaknesses just barely pass. And you see how much of them no assigned responsibility, 22%, no documentation, 35%, no covenant checklist. You can see that our group that the polling is pretty much comparable to the group. And we see that the best 3 practices are A-, and overall the benchmark group is just barely average. And then we see how it works by the 10 different criteria. So let's go to objectives. And we believe that it's just really common sense that any effective corporate process must have written objectives. And we recommend that you use 5 objectives. And the first thing you want is to really understand the debt agreements and convert the covenant requirements into actionable, understandable tasks. You'd want to integrate those tasks into the company's operations by assigning them to people, the subject matter experts, whose responsibility can impact the covenants. You'd want to determine efficiently and accurately the company's quarterly compliance. And you'd also want to manage existing and potential covenant issues to minimize the risk of future covenant violations. And you'd also want to manage senior management and lenders about significant possible covenant issues to avoid surprises and mitigate the consequences. It's much cheaper to get consents before the fact than paying waivers after the fact. Now, we're not going to go into the detail of the individual subgroups. We recommend strongly that you pull down the presentation so that you can study and see how your company compares on each of these 10 criteria and what you can do to improve it. Now, responsibilities. Any effective corporate process must have staff assigned responsibility for the process. We call these people with this direct responsibility for gathering, summarizing, and evaluating the company's quarterly compliance, the compliance team. And we recommend strongly that you have compliance team members outside of finance because they add useful insights, and they're also useful in receiving cooperation from subject matter experts in their departments, as well as their contacts with subject matter experts in other areas of the company. Now, who are these subject matter experts? Well, we'll show that on the next slide. One of the major flaws with a lot of companies' debt compliance processes is that it's really very self-contained within the Treasury group, within legal, and within accounting. And the problem is that as you move down the credit rating scale and you're in the speculative grade companies, you can easily have 80 to 100 covenants or more in your senior credit agreement. Now, the financial ratios and the permitted baskets are going to be at most 10 out of that 80 to 100 covenants. Everything else is going to be in the non-financial covenant area. And so there's going to be questions about accounting. If you look at the list, if you can read the small print, look at the list of people in accounting. There's going to be some tax questions. There may be something about insurance and requirement for insurance certificates and what happens to claim proceeds. If you've got a defined benefits program, there's going to be some ERISA questions. There may be things going on with material contracts or new acquisitions or things like that that involve senior unit management. In these days and age, there's always going to be something involving environmental or safety. Internal audit can get involved, senior management, real estate, and possibly foreign unit treasury. So the question is, if debt compliance is really just being done by Treasury alone, does Treasury really have enough knowledge, particularly for the speculative grade companies, to adequately answer this? Answer the covenants to make sure you're in compliance, and more importantly, how else are you going to find out about emerging issues in these areas that you can nip in the bud, but if you don't ask them, you're not going to know about them. Next slide. Accountability. Effective debt compliance requires active and complete evaluations by people knowledgeable about the covenants. And the classic way it's done in any corporate to encourage accountability is by documenting the attestations about covenant compliance, such as using a questionnaire process. And one of the interesting things is that questionnaires are used extensively elsewhere in the company. Often there's a property questionnaire that the insurance people put out yearly. Often there might be a financial representations questionnaire that goes out quarterly. And so questionnaires are used by many other people in the corporation for their purposes, and we look at the percentages, and we see, for example, the no assigned responsibility, no documentation, no covenant checklist. There's very little in the way of of documentation. Next slide. Now, since a default can shut a company down and crater its market cap, it is our view that the debt compliance should be regularly reviewed by the board of directors or a board of directors committee, especially for speculative grade companies. And again, we see the people involved in the 3 weaknesses have very little board review, and probably there's a reason for it, because if you have any of these weaknesses, would you really want to explain to your board that you don't have any people assigned to do it, or you've got no documentation, or not even using a covenant checklist? Next slide. Calendars. It turns out that any debt agreement has a myriad of documents that need to be regularly delivered. In addition to the financial statements, there might be special financial schedules, insurance certificates, ERISA filings, notifications of changes in material contracts, and so forth. An annual calendar listing the filing and fixed payment requirements month by month is the only way to make sure that nothing is missed, and is clearly the most popular tool used by the benchmark group, where you see, even with the people doing the 3 weaknesses, about half of them do have a calendar. Next slide. Covenant checklist. A covenant checklist is really key, because debt agreements are complex, legally dense documents that need to be interpreted into those specific actions whose execution or failure to execute results in an event of default. Since any covenant breach, no matter how small, gives the lenders the option of extracting concessions or withdrawing from the credit, a comprehensive master list of the covenants of all the debt is a requirement. Now, in the appendix, we provide you with some information on how to write a covenant checklist and some of the things that you should have it and who should be writing it. So we hope that you'll take a look at the appendix section after this is over and see how to do that for the half of the group that doesn't have a covenant checklist. Now, without a covenant checklist, of course, it's very difficult to do a non-financial covenant review. And in the non-financial covenants, which is really getting into, by definition, areas outside of finance, this is where the documentation, the covenant checklist, and going deep into the organization with the subject matter experts come together. Because the compliance team must interact with the SMEs about compliance with covenants outside the covenants, the compliance team's areas of direct responsibility and knowledge. So the issue is, how does the compliance team confirm the covenants with the SMEs. And the best practice, as you can see in the data, is to send a questionnaire, which is also documents or responses. We also recommend that you seriously consider 8B, the CFO exception report, which is a listing of all the exceptions to the covenants. These exceptions are, for the most part, are not going to be material enough to report to the lenders, but this is really going to be the listing of the issues that you'll want to monitor or manage or mitigate in future quarters to make sure that they don't become violations that you need to report to your lenders. So going on, and then we have the prospective non-financial covenant practices. And these are, again, most, when we talk about the 80 to 100 covenants, and we say about 10 are financial, we've got 70 covenants to 90 covenants that you need to review and worry about what's going to happen in the future with them. So you'd like to have your SMEs notify about pending likely issues so that Treasury and Finance can deal with them before the fact instead of having to tell the lenders after the fact. Is there a process for managing and anticipating these issues? And as you can see, the companies with those three weaknesses do a very poor job on this. And so we'll then close on the prospective ratio and basket practices. The fact that you're going to calculate your ratios and your baskets for the current quarter, well, that's a requirement for your CFO letter. So there can be no credit for doing them. What's really critical is forecasting future ratios and permitted baskets. And we see pretty low numbers. And in part, we can understand for the half of the group that are listening today that are single A's, probably it doesn't make sense for you to forecast your ratios or permitted baskets because they're so large that it really isn't a problem for you. But for the less than investment grade companies, not to forecast your covenant ratios is probably a real dereliction of responsibility. So let's move on. So summarizing it, you may recall back in criteria 1 we talked about the 5 objectives. And so here is how we believe are the best practices for achieving those objectives. And we're starting to run out of time. So we recommend that you read this at your leisure about how each of these objectives are done by various different practices that will help you achieve them. So there's slide 3, and there's slide 4 about managing the future. So let's talk about benchmarking your company's compliance. I hope that we've put the fear of God in you, particularly if you're a speculative grade company and if you have an inadequate debt compliance process. We hope that with the information that you've got on what would be better practices than what you're doing, what can be done to improve it. For those CFOs that are interested in evaluating their debt compliance process further, at no cost of obligation, if you take the same survey that we had the AFP, that was the AFP survey, we'll provide you with a customized benchmarking report with peers with the same credit rating and similar debt if you take the same survey at that URL. Now we're coming to questions and answers. And David, what sort of questions do we have from the audience?
Okay. Our first question is, how seriously do the banks view a technical default? Before you answer it real quick, though, I just want to remind everyone to use the question box in your GoToWebinar panel, as we will try to get to all of these in the Q&A. Go ahead.
Okay, Jim, do you want to answer that question?
Yeah, sure. Well, the banks are taking technical defaults very seriously because, as I mentioned earlier, it is a window into management and the capabilities of their borrower. And they do get concerned if there are always little things happening, like a missed deadline, forgetting to tell somebody about a sale of an asset, and so on. So technical defaults are very serious, and number one. And number two, technical defaults, again, transfer control of this whole situation to the lenders. So they have the ability to say yes or no at that point. Okay, David, any others?
Well,
Yes.
I'd like to add to your comment.
Sure, sure.
The other point is that if a technical default has been a snake in the grass for a couple of quarters or even for years, what happens to the penalty interest, Jim?
Well, the penalty interest would, they can go back to when it first started and do that. But then you run into and calculate that. So now you have a P&L impact. You're going to have to restate your balance sheet, as we mentioned earlier, and so on. So there's a lot of different things that can happen. But it also draws into question the credibility of the past compliance certificates. And I would say this for one of the clients that I have worked with. They found a covenant violation that had been in place for a better part of 18 months, if not further. And because of that, obviously, they went into default by the debt agreement. Then they had to do a complete audit of every requirement, and they found, I'd say another 4 to 5 issues that had never been dealt with because nobody understood them. So it was a real mess. People lost their jobs at this company, and it was a real crisis for the better part of 2 months. Okay, David?
Great. Jeff, so the next question is, I have a covenant light agreement. Why do I have to do a thorough debt compliance review?
Well, I'll take the first stab at that, and then Jim can fill in. But the problem about covenant lights is that it only refers to the financial ratios and possibly the permitted baskets. So you may not have a debt to EBITDA ratio. But all those 80 non-financial covenants are likely to be in there. And also you may have covenants that will spring into action where you all of a sudden do have financial covenant ratios if you violate one of these non-financial covenants. So it's really a misnomer. It really should be financial covenant light. Jim, can you expand on that?
Yeah, I would agree. I think it is a great marketing tool on the part of the banks, but the problem is that as we've shown today, covenants come in any number of different places within the agreement, and I doubt that any bank is going to provide any financing unless they have some controls, and those controls do remain in any type of covenant light that I've ever seen. Okay, David?
Great. And time for our last question. I have a very restrictive senior credit agreement. So do I really need a master list of all covenants included in my subordinated debt?
Jeff, you want to start with that one?
Sure. Well, the whole issue is, yes, your senior-most credit agreement is likely to have a lot of the most restrictive covenants. But the issue is, well, what about the rest of your sub-debt? Was it issued at the same time as your senior credit facility, or was it issued earlier? And if it was issued earlier, you're probably going to, it was done when your company had a different credit rating and under different credit market conditions. And also your sub-debt is going to be specialized for the various different financings that it may be financing. And so you're going to have covenants in any case that are going to be unique to that particular type of financing, whether it's something like an ABL or a convertible. Jim?
Yeah, I would go along with that wholeheartedly. Going back to the example that I've been referring to, the company that wound up with the problems of the default was not a default in the senior-most agreement. It was a default in a subordinated bond. And as a matter of fact, this company did very little, if anything, to monitor the covenants that were contained in that and to actually compare them against what was required in the senior-most agreement. And that turned out to be a major, major issue. Okay, David?
Thank you, Jeff and Jim. We appreciate that, and really appreciate your presentation. I want to let the audience know we will have a link in the post-survey, so if you would like to connect with Jim or Jeff or have any additional questions, here is also their information on the screen. And they have put out a good list of publications and references, a great document if you download the slides there. So again, thank you guys, great presentation.
Thank you, David, and thanks to Proformative, and thanks for everybody for coming to this webinar.
I do want to remind everyone before we close the webinar down, we will have a short survey at the end, and we do have our final polling questions. We also do have our conference coming up for CFO Dimensions, August 22nd in New York. This is the premier Finance Strategic Leadership Conference, and hope that you'll be able to attend. We also, one more thing before we wrap up, we wanted to extend this opportunity to participate in our Treasury Management Benchmark Survey. As a registrant of this event, we would like to get your perspective on the role of Treasury management. This survey is open to finance, accounting, and Treasury professionals alike. And in appreciation for your insights and time, we're offering a $25 Amazon gift card for your completed submission. If you would like to take the survey, it is at performative.com/survey/webinar, and that will also go out in the post-event email for you to go. As I mentioned, there will be a short survey at the end of the presentation. We do ask that you will give us your feedback so we can continue to make this even better. Please join us at performative.com to continue this discussion and ask any questions that you had. If you have any issues with CPE, we can be reached at cpe@performative.com. I will now launch the last polling question. Please remember, everyone looking for CPE, you do need to answer all 3 polling questions. It should be on your screen there now. Also, I want to thank the audience for your time today. We do appreciate you coming back to Performative and always want to provide you with the best return on your time. Please do answer that survey, as we do look at your feedback, and we appreciate everything that you give us there. I'll leave this open just for a few more minutes so everyone can get their responses in. We do ask everyone to answer the polling question. Before I close the webinar down, please complete our survey, which will be showing up on your screen shortly. I want to thank everyone for your time, and I hope to see you at another event soon at performative.com. And there are the results of the last polling question. So again, thank you, everyone. Any comments on these guys?
No, but it's about what I would expect from the group with you know, that are single A and triple B and so on. So this is good. Okay, this is good. But there are a lot of people that are very honest about that. Okay, thank you again.
Thank you, guys. This concludes our webinar. Have a great end of your day.